Hello, everyone, and welcome back to Synaptic Investing. I hope you're having a fantastic week and are ready for another deep dive.
Always ready.
Today, we're breaking down one of the most, I'd say, fascinating behemoths in the real estate sector right now. We're looking at American Homes for Rent, ticker symbol AMH.
Yeah, this is the big one.
On the surface, this looks like a straightforward bet. It's a company that owns real, tangible assets, houses, in a time where housing scarcity is literally the headline of every single newspaper.
Right.
But the critical question for us as long-term investors, the thing we really need to figure out today is this. Are we looking at a true compounding machine that can dominate for decades? Or is this just a highly capital-intensive utility that's kind of masquerading as a growth stock? Is the easy money era for this specific trade officially over? That is the puzzle we are going to solve today.
That's a huge topic. And before we dive deep, a quick heads up for the audience.
Right. If you're looking to execute these trades, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business engine.
Yeah, let's start by cracking open the black box of operations here, because I think there is a massive misconception among retail investors that American Homes for Rent is just a really, really rich landlord.
Oh, absolutely.
Like a guy with 1,000 rental properties who just sits back and collects checks. But when you look under the hood, this isn't really a traditional landlord business anymore. It is essentially a logistics company.
Exactly. If you treat it like a traditional landlord play, you miss the nuance entirely.
Yep.
The core transaction is simple enough on paper, right? They acquire, they develop, and they manage single-family rentals, or SFRs.
Right.
A tenant signs a 12-month lease, they pay rent, and AMH eats the friction costs, the property taxes, the insurance, the maintenance. But the difference, the thing that totally changes the DNA of the company, is the sheer scale.
Right, and that scale changes the entire nature of the beast. We aren't talking about a portfolio of 10 homes or even 100 homes. We are talking about a portfolio of over 60,000 homes. And I just want to pause on that number for a second because it's hard to visualize. That is the size of a small city.
It is a small city, but it's a city scattered across 20 distinct geographic markets. And usually, in real estate, scale is actually a headache. This is what people forget when they look at this space.
Yeah, more doors equals more problems.
Exactly. If you own one rental property, you know the roof leaks at 2 a.m. and you handle it. If you own 10, you're busy, you're stressed out. If you own 60,000, statistically speaking, hundreds of roofs are leaking right now, this very second. Hundreds of HVAC units just failed while we were talking.
So how is that a moat? Because to a layman, that sounds like an operational nightmare. If I'm an investor looking at this, why do I want to own a company that has to deal with hundreds of leaky roofs every single day?
It becomes a moat when you apply true industrial logic to it. This is the classic economies of scale argument, but let's make it tangible for the listeners. Think about the absolute nightmare scenario for a regular mom-and-pop landlord. It's 2:00 a.m. on a Tuesday, your tenant calls in a panic, water is pouring through the kitchen ceiling. What do?
You panic, you swear, and then you call the only emergency plumber in the local listings who actually picks up the phone at 2 a.m.
Exactly. And because you are desperate, he charges you triple time. You're paying $400 or $500 just for him to pull into the driveway. You have zero leverage, you have no choice, and you're paying retail prices for whatever parts he needs. You are a price taker in the worst possible way.
Right, you are entirely at the mercy of the spot market for labor.
Now flip that scenario to American Homes for Rent. That exact same call comes in. It doesn't go to a sleeping landlord. It goes to a centralized 24/7 dispatch center. Their software knows exactly which salaried maintenance tech is closest to that zip code. It knows that Tech A has a specific skill set for plumbing. It deploys them.
And they aren't stopping at the local Home Depot on the way to buy a valve at retail price, are they?
Not at all. They are driving a company van that is already stocked with standardized parts that AMH bought in bulk directly from the manufacturer for probably 40% less than the mom and pop pays.
Wow.
The tech goes in and fixes it in 45 minutes because they've fixed that exact model of toilet or pipe 500 times across the portfolio. The total cost to AMH for that incident might be $60 in labor and parts. The cost to the mom and pop is $600. Multiply that massive variance across 60,000 homes, and you start to truly understand the logistics mode.
Okay, that makes perfect sense. You're taking this highly chaotic, unpredictable event and turning it into a standardized, predictable widget. That is the business engine. But let's look at the output of that engine right now. We have a snapshot here from February 2026. The operational performance looks robust. We are seeing 3.5% same-home core net operating income growth, and NOI, as we know, is the metric that really matters here.
Right, net operating income is the absolute holy grail for REITs. Yeah. And that 3.5% growth is being driven by two main things: higher rental rates and an occupancy rate sitting at 95%.
Which is very high.
It's incredibly sticky.
Yeah.
It shows that despite all the macroeconomic noise out there, despite the inflation we've seen, people fundamentally need somewhere to live. Shelter is non-negotiable.
But, and there's always a but in these analyses, how much true pricing power do they actually have? Because I see bulls online assuming they can just raise rents 5% or 6% annually forever. The argument is basically, hey, housing supply is low, therefore AMH can charge whatever they want. Is that a reality?
That is the most dangerous assumption you can make in the SFR space. Their pricing power is not infinite, not even close. It is strictly and severely bounded by two things: local wage inflation and housing affordability caps.
Meaning what, exactly?
Meaning you absolutely cannot raise rents if your tenants' wages haven't moved up. It does not matter how good your dispatch logistics are or how nice the vinyl flooring in the house is. If the tenant physically cannot pay the new rate, you have a vacancy. And vacancies destroy NOI faster than anything else.
So they are completely tethered to the reality of the American paycheck in these local markets.
Exactly. You can't squeeze blood from a stone. If median wages in Atlanta or Phoenix are flat over a 2-year period, AMH's rent growth in those markets is eventually going to be flat. They are not immune to the broader macroeconomy, no matter how good their software is.
That's a really great transition to our second pillar, the mental model, because to really understand AMH today, you have to look backward at the history. You have to understand how this massive beast was built in the first place.
Right.
And looking at it, it instantly reminds me of Charlie Munger's concept of the Lollapalooza effect.
I love that you brought this up. The Lollapalooza effect is arguably one of the most powerful yet underused mental models in fundamental investing. Munger basically used it to describe a rare situation where multiple distinct forces, whether they are cognitive biases, economic trends, or psychological triggers, all happen to act in the exact same direction at the exact same time. The result isn't just A plus B plus C. It's entirely nonlinear. It's an exponential outcome.
And AMH absolutely rode a massive Lollapalooza wave in the 2010s to get to where they are.
They absolutely did. I mean, just think about the cocktail of macroeconomic forces in 2012, 2013, and 2014. First, you had profound structural housing scarcity following the 2008 financial crash. No one was building. The major home builders had basically gone bust or halted production.
Right.
Second, you had institutional cost of capital advantages. Debt was essentially free for big corporations.
Right. Interest rates were pinned at zero.
Exactly. And third, you had a massive demographic shift happening simultaneously, where millennials were delaying marriage, dealing with student debt, and heavily favoring renting over buying. So you had completely free money, surging demand, and absolutely zero new supply.
It was the perfect storm.
It was a critical mass of competitive advantage, where the whole was vastly greater than the sum of its parts. They could literally buy distressed homes for pennies on the dollar. I mean, buying foreclosures on the courthouse steps, in bulk, finance them with dirt-cheap institutional debt, and immediately fill them with reliable tenants who had no other housing options. That was the Lollapalooza.
But, and here's where we have to be extremely realistic as analysts today. We are recording this in 2026. Is that Lollapalooza effect still happening, or has the music finally stopped?
The music hasn't stopped completely, but the tune has definitely changed. And this brings us to what I like to call the Anti-Moat check. If we look at the current reality, the boots-on-the-ground reality of 2026, that historical moat we just praised is under severe pressure.
How so? Break that down.
Two main factors are driving this. First, the space is incredibly crowded now. 10 years ago, institutionalizing single-family rentals was a brilliant form of counterpositioning. It was a contrarian bet against scattered, inefficient mom-and-pop landlords. Now, everyone is doing it.
Right. Wall Street figured it out.
Private equity, other major REITs, pension funds, everyone wants a piece of the SFR market. The secret is out.
So you can't just quietly buy up a distressed neighborhood in the Sun Belt anymore without getting into a bidding war against BlackRock or Invitation Homes.
The secret is totally out, and the easy arbitrage is gone. And that brings us to the second anti-moat factor. The yield spread itself is basically commoditized. Back in the day, you could buy a house and get a rental yield that was massively higher than your cost of debt. Now, you have soaring property tax assessments naturally catching up to these inflated home values, and you have permanently elevated interest rates. The easy money, that free lunch of the 2010s decade, is officially over.
That makes a lot of sense. The gap between what it costs you to borrow the money and what you actually make in net rent has just shrunk to a normal, highly competitive margin. But I want to touch on something else regarding their soft power, their brand. We talked about occupancy being super high at 95%. Retention is historically high. Does that mean these tenants actually love the brand? I mean, is there brand love here like you see with Apple or Costco? Do people wear American Homes for Rent t-shirts?
I would argue absolutely not, and this is a very crucial distinction for investors to grasp. High retention or low churn in the single-family rental business is not a function of brand love. It is almost entirely a function of switching costs.
Because moving is just terrible.
Moving is a nightmare. It
Oh,
is highly financially expensive. You need a new security deposit. You have to hire movers. You have new utility setup fees. And it is procedurally painful. You might be changing your kids' school districts, updating your address everywhere, packing for weeks. Tenants stay with AMH because the alternative of leaving is painful, not necessarily because they are deeply in love with their corporate property manager.
which actually creates a bit of a fragile relationship with the consumer, doesn't it? If a genuinely better, cheaper option appears across the street, they might just bolt. It's a grudging loyalty. But moving on, I want to look at the inside view risk you mentioned in your notes, the human capital aspect of this operation. Because we talked a lot about the dispatcher software handling the maintenance flow, but software doesn't physically fix a broken toilet.
No, it doesn't. And this is the daily operational grind that software can never fully fix. You can have the best AI dispatch algorithm in the world, but eventually a human being with a pulse has to drive a van to a house in the suburbs of Atlanta and literally turn a wrench. Running 60,000 scattered homes means managing a massive distributed fleet of local blue-collar maintenance workers.
And in a tight labor market where trades are scarce, that has to be incredibly tough.
It's incredibly tough. Plumbers, electricians, HVAC tech, these are highly skilled trades. They are in massive demand across the entire construction sector. If a good HVAC tech can go make $100,000 working for themselves or a commercial builder, why would they work for AMH for $60,000 or $70,000? Keeping those specific people on staff, keeping them motivated, and keeping them efficient is a constant, unyielding drag on margins. It's the unglamorous, heavy-lifting reality that ultimately limits how profitable this business model can truly become.
Speaking of profitability, let's transition to Pillar 3, financial resilience. We need to do a real forensic check on the numbers here, because despite that maintenance grind you just described, the margins actually look, well, surprisingly good.
They do look good. If we look at the income statement trends over the last few years, the operating margins have expanded aggressively. Back in 2020, they were sitting around 13.2%. Fast forward to the trailing 12 months for 2026, we are looking at approximately 28.0%.
That is a massive jump. That's more than doubling the operating efficiency of the business. And I have to be honest, usually when I see a company claim they doubled their margins in just a few years, my analyst brain gets very suspicious.
As it should.
I want to look closely at the quality of earnings, specifically stock-based compensation, or SBC, because we see this all the time in the tech sector. A SaaS company comes out and says, look, we made a huge profit. But when you read the footnotes, they paid half their engineering team in stock options that they conveniently don't show as a cash expense. Is AMH playing games, cooking the books with SBC?
This is a critical litmus test for management integrity. And frankly, AMH passes with flying colors. I specifically dug into the filings looking for this exact thing. In the tech world, like you said, we are so used to seeing adjusted earnings that are 50% or even 100% higher than GAAP real earnings because they hide all the salary expense and stock grants.
Right, the infamous tech add-backs. They just pretend stock isn't real money.
Exactly. But here, SBC is extremely light. We're seeing about $25 million in stock-based compensation against $811 million in operating cash flow. That is roughly a 3.1% impact on the cash flow. That is negligible.
So the earnings we are looking at are real cash.
The earnings are real. When management says their margins are up, it's because they are actually spending less physical cash to run the daily business, not because they are quietly diluting everyday shareholders to pay the CEO a massive stock bonus.
Yeah.
That is a huge green flag in an era defined by financial engineering.
Okay, so the earnings are clean. I'll give them that. But I want to push back and challenge you on the actual returns. Let's look at the return on invested capital, the ROIC. Because for a true compounder, which is what the bills always claim the stock is, We usually want to see an ROIC well above 15%. What is AMH actually hitting?
They're sitting at about 3.5%.
Ouch. I mean, 3.5%? I can get close to that in a risk-free, high-yield savings account right now.
Oh.
Why on earth would I buy a volatile equity stock that only yields 3.5% on its core capital?
That is the immediate knee-jerk reaction. And look, if this were a software company, a 3.5% ROIC would be an absolute disaster. But you have to contextualize the asset class. This is asset-heavy physical real estate. The denominator in that ROIC equation, the invested capital, is absolutely massive because they own billions and billions of dollars of physical homes and land.
And I assume leverage plays a major role in how we should view this.
Leverage is the key to the whole model. Leverage is a structurally necessary component of the capital structure in real estate.
Yeah.
You don't buy this stock expecting tech-like ROIC on the unlevered assets. You buy it for the return on equity, which is magnified by their debt stack. If they borrow fixed debt at a reasonable rate and earn a 3.5% baseline yield on the total massive asset base, the actual return on your equity is significantly higher.
Right.
But, to your point, strictly speaking, this totally fails the traditional hurdle rate for an elite capital-light compounder. It confirms that this is a heavy capital-intensive business. You have to constantly spend huge amounts of money to make money here.
Which leads us perfectly into Pillar 4, the growth pivot. Because if you can't just buy cheap, distressed houses off the courthouse steps anymore and your baseline ROIC is fundamentally tight, how do you actually grow the top line? You can't just sit back and rely on passive home price appreciation to drive the stock.
No, you can't. And management knows that. And this is the biggest, most aggressive strategic shift in the company's entire history. We are watching them shift in real time from an acquisition model to a development model.
Explain that pivot for us. What does that actually look like?
Well, for the first decade, they were primarily buyers. They went to the MLS, the multiple listing service, and bought existing, mostly distressed homes. But as we discussed, that channel is basically dead. You cannot buy a normal retail home on the MLS today, pay the inflated 2026 market price, and make the math work as a profitable rental. The yield is just too low to cover the cost of capital.
So they literally have to build them from scratch.
Enter the build-to-rent, or BTR engine. AMH is now effectively acting as a massive residential developer. They aren't just buying houses, they're buying raw land, putting in the street infrastructure, the plumbing, and constructing entirely purpose-built rental communities. We're talking about entire suburban neighborhoods where every single house, from the start, is an AMH rental property.
That sounds impressive on paper, but as an analyst, it also sounds incredibly risky. Development is a notoriously hard business. You have complex zoning laws, you have angry and MBOYs, Dean under my backyard crowds at city council meetings, you have volatile lumber and concrete prices.
It is incredibly risky, but it is the only way they can bypass the retail market gridlock. They aren't trying to outbid a young married couple for a 1970s ranch house that needs a new roof anymore. They're building brand new inventory that is designed from day one specifically for high durability and low maintenance.
So they get to entirely control the physical product.
Exactly. They don't put in cheap carpet that has to be replaced every 2 years. They put in commercial-grade vinyl plank flooring. They standardize every single HVAC unit and appliance across the neighborhood. And that directly feeds back into that logistics moat we talked about in Pillar 1. When a fridge breaks in a BTR community, the tech knows exactly what part to bring because AMH chose the fridge.
Let's talk about the TAM, though, the total addressable market for this specific BTR strategy. Theoretically, the housing market is infinite, right? Every new family needs a house.
Theoretically, yes, the demand for housing is massive, but practically for an investor, the profitable TAM is actually shrinking. Vertical construction costs, the lumber, the concrete, the specialized labor are extremely high, and land prices in desirable Sunbelt areas are incredibly stubborn. Just because you can physically build a house doesn't mean you should. The profit margins on development are significantly tighter today than they used to be.
So given that tighter margin reality, how is the CEO actually spending the cash flow? What is the current cash deployment hierarchy? Because if development is getting structurally harder, are they just hoarding cash on the balance sheet?
Not hoarding, no. The bulk of the operating capital is still going right into that organic growth funding the BTR pipeline. That's their primary bet for the future. But there is a secondary capital allocation signal right now that I think is very interesting.
You're talking about the dividends and buybacks.
Exactly. Management just hiked the dividend by a solid 10%, which puts the current yield around 4.2%. That's a very healthy payout for income investors. But even more telling than the dividend, they authorized a $500 million share buyback program.
Now, usually companies do stock buybacks when they literally have nothing better to do with the cash. But you think this buyback is a specific signal.
I absolutely interpret it as a signal that management views their own stock as undervalued by the public markets. It passes what we call the outsider test, referencing William Thorndike's classic book, The Outsiders. Elite capital allocators actively buy back their own stock when it sells for less than intrinsic value. It tells us that management thinks the market has punished their equity price too severely. They're effectively telling the market, we can get a better, safer return buying our own existing portfolio at $30 a share than we can going out and building a brand new house from scratch.
Well, let's find out if the market has actually punished them too severely. Let's move to Pillar 5, valuation and the verdict. Let's look at the actual price tag today.
So, referencing the market snapshot from late February 2026, the stock is trading right around $30.87.
And what do the multiples look like at that price?
We are looking at roughly 16.3 times forward funds from operations, or FFO, and on an enterprise value basis, about 14.4 times EV to EBITDA.
16.3 times FFO. For context for our listeners, where does that sit historically for this specific company? Is that considered expensive?
It's actually a discount. Historically, over the last cycle, AMH has typically traded closer to a baseline multiple of 18 to 20 times FFO. So the market right now is pricing it lower than its own historical average.
Why the discount? Is it what you call the reverse DCF logic? What exactly is the market pricing into this stock? And for the listeners who haven't opened a complex Excel spreadsheet in a decade, can you quickly translate what a reverse DCF is?
Sure, it's simpler than it sounds. Think of the current stock price that $30.87 is the final answer to a complex math problem. The market has already done the math to arrive at that price. The reverse DCF, a discounted cash flow model, lets us basically work backward from the answer to find out what growth assumptions the market used to get there.
So we are reverse engineering the market's collective expectations.
Exactly. We reverse engineer the sentiment. And when we unwind that math at $30.87, the market is effectively saying, we collectively believe American Homes for Rent will only be able to grow its cash flow by about 4% to 6% per year in perpetuity.
4% to 6%. That seems incredibly pessimistic for a company that just doubled its operating margins. That's barely keeping up with core inflation in some markets.
It is pessimistic. It's what I call a pure fear discount. The market is looking at elevated interest rates. They are looking at the negative political headlines regarding landlords, and they are assuming the company's growth engine is fundamentally broken. But here's the opportunity. If you as an investor believe they can grow even slightly faster than that, say 8% or 10% through their BTR pipeline, then the stock is mathematically cheap right now.
Okay, so the market is fearful, and that might create a window. Does that create a real opportunity today? Let's triangulate the true intrinsic value. What is this company actually worth per share?
I like to use 3 distinct methods to triangulate fair value, just to make sure we aren't relying on one biased model. First, let's do a simple mean reversion. If we assume the macroeconomic fear calms down and AMH just goes back to its normal historical 18x multiple on the projected 2026 FFO of roughly $1.92, you get an implied price of $34.56.
Okay, so nearly $35. That's some decent upside from $30.87.
Second, let's look at the broader analyst consensus. The smartest analysts on the street who cover the sector full-time have an average target price of $37.44. And some of the most bullish analysts are as high as $43.
And what is the third method?
The third is what I call simplified owner earnings. This is a very conservative approach where we take the total operating cash flow and we strictly subtract the necessary maintenance capex, the money they have to spend, just to keep the current houses standing. But we completely ignore the discretionary growth spending for new builds. When you normalize that pure cash yield, it implies a baseline value closer to $32.
So we have 3 targets: $34.56, $37.94, and $32.
Exactly. So if we blend those together, the intrinsic value confidently triangulates somewhere between $32 and $25 a share.
And the stock today is sitting at about $31.
Right. So at $31, you are essentially buying a dollar bill for 90 cents. That's fine. It's not a bad deal, but it's certainly not a screaming bargain.
It's fairly valued. There's no huge asymmetric upside that makes you want to back up the truck. So where's the true buy zone? If I want to be a highly disciplined, patient investor, where do I set my limit order and just wait?
To get a genuine sleep-at-night margin of safety, where you are basically buying that same dollar bill for 70 cents, the buy zone is really between $25 and $28. That's where you want to be greedy. Right now, at $31, we are in strictly hold territory.
So the advice is Don't chase it here. Collect the dividend if you own it, but definitely keep it on the high priority watch list. Now, before we let everyone go, we absolutely have to do the most important part of any deep dive. Pillar 6, the premortem.
This is always my favorite part of the analysis. Inversion thinking.
Exactly. We have to look at the dark side and ask, how do we lose 100% of our money? What fundamentally kills this company?
I see two major existential risks here. The first is regulatory disruption. This is the classic tail risk.
You mentioned the political rhetoric briefly earlier.
It's getting louder by the day. There is massive growing political momentum targeting what they call Wall Street landlords. And we aren't taking a side here. We're just looking at the source material and the reality of the political climate from both the left and the right. Whether it's left-wing politicians arguing fiercely about housing affordability and tenant rights, or right-wing populists arguing about the destruction of the American dream of single-family home ownership, both sides of the aisle actually have deep ideological reasons to hate this specific business model.
It's honestly one of the few things they seem to completely agree on right now.
Exactly. And because of that rare bipartisan anger, there are serious proposals floating around in various legislatures for outright bans on institutional buying of single-family homes, or even aggressive national rent control initiatives. If sweeping legislation passes that artificially caps their top-line rent growth or legally forces them to liquidate chunks of their portfolio, the stock collapses. It's a binary outcome.
Well, that is terrifying for a long-term holder. What's the second major risk?
The reflexive debt spiral. Remember, real estate at this scale is ultimately a leverage game. If inflation stays stubbornly high and cap rates blow out, meaning the underlying property values drop significantly relative to the income they produce, their leverage ratios automatically rise.
Even if they didn't borrow a single extra dollar?
Exactly, because the asset denominator shrank. If asset values drop, they immediately look riskier to their institutional lenders. If they look riskier, their cost of refinancing debt goes up. If the cost of debt goes up, the entire build-to-rent engine stalls out completely because it's no longer mathematically profitable to build new houses. It becomes a vicious downward spiral that traps their equity.
That brings us perfectly to the red team challenge. I want you to give me the absolute strongest possible argument against owning this stock today. Be the ultimate bear. Convince me to sell every share right now.
Okay, here is the pure bear case. And honestly, it is highly compelling. The core argument is this. You're buying a highly capital-intensive grinding business that is temporarily masquerading as an elite compounding machine.
Go on. Flesh that out.
The bear would aggressively argue that AMH's incredible success over the last decade wasn't actually due to management skill or some genius logistics moat. It was pure beta. They just rode the greatest real estate macro wave in history. They bought distressed homes at absolute generational lows in 2012, and they rode interest rates straight down to zero.
Anyone could have made money doing that.
Right. And the bear says that specific playbook is permanently broken. Now, in 2026, they are forced to build brand new houses at absolute peak construction costs,
Right.
while simultaneously financing that construction with very expensive debt. The crucial difference between what they earn in rental yield on a new house and what it costs them to finance it has compressed dramatically.
So the bear is basically saying their future capital deployment is going to systematically destroy shareholder value rather than create it. They are spending billions to build houses that yield less than their weighted average cost of capital.
Exactly. They are running incredibly hard on a treadmill just to stand completely still.
That is a very sobering thought for anyone holding this for the next decade. So let's wrap this up with the outro. What is your honest 5 to 10-year view? If an investor buys this at fair value and holds it through all this macro noise, what do they actually have in their portfolio?
I think investors just have to severely adjust their expectations. AMH is steadily transitioning from being an exciting growth story into a very boring, mature utility.
It's basically becoming the electric company, but for housing.
In a way, yes, that's the perfect analogy.
Yeah.
I think going forward, you can realistically expect total shareholder returns, or TSR, in the 7% to 9% range annually. You'll reliably get that roughly 4.2% dividend yield, plus some very slow, grinding capital appreciation from the steady BTR completions. It is a highly robust defensive asset to hold if you are worried about long-term inflation. But do not expect the hyper-growth tech-like returns of the last decade. It's essentially a high-yield corporate bond with a built-in inflation rider.
A bond with a roof. I really like that framing. So here is my final provocative thought for the listeners to mull over as we close out.
Let's hear it.
We talked extensively about all the downside risks today, but consider this completely opposite scenario. If the broader housing market completely crashes again, I mean a real structural crash, AMH isn't necessarily the victim in that scenario. They have an ironclad balance sheet today. They instantly become the apex predator again. They can sweep in with billions in liquidity and buy distressed retail assets just like they did back in 2012.
They absolutely could.
But in a slowly stagnating market like we might actually be seeing now where things just kind of chop sideways, are you really better off owning the landlord dealing with the leaky roofs and the property taxes? Or are you better off just owning the bank that lends the capital to them?
That is the ultimate asset allocation question. The bank takes significantly less operational risk and always gets paid first.
Exactly. Just something for everyone to think about as they review their portfolios. That wraps up our deep dive on American homes for in-rent.
Thanks for listening, everyone.
We'll see you in the next deep dive.